Hello, everybody. So welcome to our class. I know we're having some trouble getting access, and I'm not sure why. I've been trying to give it to you. So you got to let me know. Well, I guess if you're on, you know already that you have access. But I have had issues with it, and I'm not sure why. So, I've been working on it, and I've been talking to the school why it's so difficult, but um, I'm going to keep working at it till we get it right. So I want to make sure you have access to this thing. So we're on week 2 already. And, I'm going to keep checking this is to make sure I can get that, make sure you get access to this thing. You should be able to once you open up the classes. That's what's confusing me. Why it's not coming up. This is extremely confusing. Why you're not getting access to these videos. Check this. Yeah, why you're not getting access to these videos, but we're going to keep working on it till we get it right. Okay, so this week we're looking at the capital asset pricing model. And right here, week 2. And just look at it from the standpoint. Now, one thing I want to point out is this is the work that you have this week. So you have to find a portfolio. Well, let's look at SCORM first, then I'll come back to this. Then I'll come back to this, and I will get you access. Okay, and I will get you access. One way or the other, I'm going to get it to you. Matter of fact, I'm going to send you guys a message right now. Just sending you a message. I'm asking you to text me immediately. And I will get on this right away. I do not want. Okay, so I sent you an email, and you're seeing this already, but that you should contact me. And let's hope that hopefully we get this straight. All right, so at any rate, what are we doing this week? We're looking at a model to look at the covariance of securities, which means it's a fancy word to say that if I put enough securities in a portfolio, they will lower my overall risk. Because if you go back to your statistics 101, you know that risk is a function of your expected rate of return, right? Your expected rate of return plus variance, right? So you have an expected rate of return, which is an average rate of return. So if I think the market goes down, I say we could lose 5%. If the market goes sideways, we could make 10%. If the market goes up, we can make 20%. Then you put probabilities on it, like 20% times minus 5, 50% times, what did I say, 10%. And then you do the last like 30% with the up market, up 20%. You're going to come up with an expected rate of return. But what expected rate of return is not enough. You also have to know what the variance is from the average, and that's variance of the mean. So optimization models are a type of mathematical model that attempts to optimize an objective function without violating resource constraints. So without violating the constraints that you put or the limits that you put, you're trying to optimize you're trying to optimize an objective function. And our function in this case is to lower the variance. Finding an alternative with the most cost-effective or highest achievable performance under the given constraints by maximizing desired factors. In comparison, maximization means trying to obtain the highest result, right? Practice of optimization is restricted by the lack of full information and the lack of time to evaluate information is available. In computer simulation modeling of business problems, optimization is achieved usually by linear programming techniques. So what we're trying to do is find the maximum value. I just want to check that I'm, bear with me for a minute. I always like to make sure that I'm recording. Okay, good. Says stop. Okay, so I should be recording. Let me make sure I'm also sharing my screen. That would help, right? We are presenting. Okay. We are presenting. But so recording and presenting. All right, let's double check that. Good. So that's what I'm looking at. Right? That's what I've been reading off of. And portfolio optimization is the process of selecting the best portfolio out of a set of all portfolios according to some objective. The objective typically is to maximize factors such as the expected rate of return and minimize risk. So we're trying to get the most return with the least amount of variance. Go back to your statistics, the least amount of variance. So factors being considered may range from tangible, such as assets, liability, earnings, to intangible, such as selective divestment. So what it means is we could either mix our assets or liabilities together to get that return, or get some stuff out of your portfolio to get a better return. Okay, so the tangible is putting them in, the intangible is taking it out, basically. Let's turn to the lesson menu. So the capital asset pricing model is the model that describes the relationship between systematic and unsystematic risk, particularly stocks. Capital asset price model is widely used throughout finance for the pricing of risky securities. Generally expect the rate of return. So with the capital asset, and here's what I'm going to do for you. I told you from day one that I had a YouTube channel. So I know that I'm really into I'm into anything that's going to help, right? And in my playlist, I have Finance Academy, right? And what I'm going to do is I'm going to go right to 2 videos that I did on the capital asset pricing model, right? Really important ones, I thought, okay? Okay. So we're going to stop that there. I'm going to share this. And what I'm going to do is put it in all week's work. So this way you have it. Put it in all week's work. Right, and we're going to go to a course. I'm going to close this just for a second so you could see even live how I'm putting this down. Okay. Create a link. That's CAM. And so you could watch this at home at your leisure. And that should be a big help to you, right? That should be a big help to you. I'm going to do the second one. Go back here. Pick part 2. Highlight it. Stop. Here. There. I go back here. And link up here. We're going to make that visible to students. So there you go. I'm going to put them together so you have them. So now you know where to find these. So going back to our work. Right, going back to our, and I gave you other information on good example of beta. Going back, and so you should watch that video. Is really what you should do. And what it basically does, capital asset price model, it defines the risk-free rate, which is about 5% now, which is usually the U.S. Treasury rate, the 10-year Treasury rate. And remember, if you can't make at least the risk-free rate, why would you even invest? Why would you invest in anything that does worse than the risk-free rate? You're not taking risk. Isn't that the whole purpose? Is to gain as much return with the least amount of risk? Think about it. So the way the model is designed, you should take the risk-free rate, which is the rate you get on the 10-year Treasury, plus the relationship between the market and the stock, which is called beta. Beta is when you do a linear regression, beta is the relationship between the stock and the overall market. So what the capital asset pricing model is basically saying is you could price any asset by finding the risk-free rate and then adding the relationship of a stock to the market less the risk-free rate. The general idea is that investors need two forms of compensation: time value of money, which is the risk-free rate, and risk, which is the beta. The risk-free rate in the formula represents the time value of money and compensates the investor for placing money in any investment over time. Okay, and we said that the risk-free rate is, generally speaking, the U.S. Treasury. The other half of the capital asset pricing model formula represents risk and calculates the amount of compensation investor needs for taking on additional risk. You can calculate this by taking a risk measure that compares the returns of the asset to the market over time and the market premium. So the risk of the market minus risk rate is the market premium. It's the extra return you get for investing in the market. The return of the market in excess of the risk-free rate. Beta reflects how risky an asset is compared to the overall market risk and is a function of the volatility of an asset. So what you're doing, and if you watch my video again, I'm going to keep saying it, you're going to see the relationship. So the capital asset pricing model says the expected return of a security or a portfolio equals the rate on a risk-free security plus a risk premium. If this expected return does not meet or beat the required return, then the investment should not be undertaken. So if this expected return does not meet what you think, the expected return should equal the rate on the risk-free security plus a risk premium. If this expected return does not meet or beat the required return, so once you've determined what your return is, if your expected return doesn't beat that, right? If the expected return does not meet or beat the required return, then the investment should not be undertaken at all. Okay, then the investment should not be undertaken at all, right? Because once you've determined through analytical measure, assuming you trust the capital asset price model, what the expected return should be, if it's not meeting it, what you think it's going to, what you think the stock is going to return doesn't meet that, you shouldn't take the investment. Risk-free rate is the theoretical rate of return on investment with no risk. In theory, the risk-free rate is the minimum return an investor expects from any investment, because he will not accept additional risk unless the potential rate of return is greater. In practice, however, the risk-free rate doesn't exist because even the safest investment carries small risk. Thus, the interest rate on the 3-month Treasury bill is often used. Or I also think the 10-year is another example. And then I gave you this thing on beta. What is beta? Stocks have, all right, let's get back to that in a minute. I think that's really important for us to talk about. Beta is a measure of the volatility or the systematic risk of a security or portfolio in comparison to the market as a whole. Beta is used in the CAPM. So in general, if a beta less than 1 means the stock is any investment is less volatile. 1 greater than 1 is more volatile. We usually use the S&P 500 as the comparison. So the overall market is volatility also, which we usually measure by using the volatility of the S&P 500. Beta is essentially the comparison of the volatility in a particular stock to the market as a whole. So greater than 1 means it should be greater than the market as a whole. Less than 1 means it should be less than the market as a whole. Okay? Just take a look at this for a minute. We'll leave that up for a minute. I'm going to step out for 1 second. Please take a look at this because I think it's a great way to explain beta. Okay, so back. So stocks are assumed to carry two types of risk: the idiosyncratic risk or the unsystematic risk, which is the risk that every stock has, like Coca-Cola. People want to stop drinking sugary drinks. An airline, people want to stop using the airline. Energy costs go up. What else? Anything like that. An oil driller, energy costs go down. You can nullify those risks by diversifying stocks, but the risk in the general market cannot be diversified away, and that's the risk we're looking to measure with beta, and not to be confused with alpha. Alpha measures the outperformance after volatility has been considered. If a stock has a beta of, say, 1.5 when the market rises 6%, then that stock on average will move up by 9%. If the stock moves up 11%, it has achieved alpha. So basically, what alpha tells us is how much did I beat the capital asset pricing model, right? Beta tells us actually measures the volatility of my stock versus the market. So two different things. Beta measures the volatility of your stock versus the market, any stock you're looking at, any asset you're looking at. Where alpha measures your outperformance after considering beta. Looking at Disney today, which had big news, the stock has really gotten hit hard. And one of the main reasons is it just has not performed. I mean, it's been a horrible performer. This is almost $190 stock. So now they have activist investors looking at it. But the reason why they're looking at it is the stock just isn't doing. I just thought I'd point that out. So that's a stock that's having an issue. Okay, so we go back to our class. And I want to go back to that little. So the statistical definition of beta is done with a regression, the covariance of the risk of a stock over the risk of a market, divided by the variance of the risk of the market. So it's the covariance, or the relationship between both over the variance. So R M is the return of an individual stock. RE is the return of the overall market. We look at the covariance, how changes in stocks' returns are related to changes in the market, and how far the market's data points spread out from their average value. So we're looking at how far the market's data points spread out from their average value, and then we're looking at the covariance of each stock. So it's a little more involved. You don't have to know all of this, but you have to at least understand where these numbers are coming from. Okay, you have to understand where these numbers are coming from. I'm just taking some copies to give to you guys. And that's what a stock's beta chart looks like. It shows the stock return versus the market return, and it plots it. It's usually a direct correlation because it's market generally affects all stocks, and then it plots the points. It helps determine when a stock is outperforming expectations. It determines how the addition of a stock will affect the expected return of a portfolio, and it determines the addition of stock will affect the volatility of a portfolio. Okay. Beta is not constant. This is one of the problems with it, and not reliable for short-term. Not reliable for short-term projections. Okay. A little bit on beta. Okay. Which I think is really helpful for you to remember. Okay. That's all. You can go back and watch it. You can also watch my videos. So going back to our class, that's complete. That should give you a good idea. Now the portfolio calculations really tell us how to look at 12 stock holdings, and your manager should review a portfolio of a client's portfolio to determine the risk-reward profiles. He also says he cannot install an expensive database to do calculations. Here's where you come in. Whoa, a lot of work. Determine the monthly average returns, determine the monthly standard deviations, which is not just the returns, but the volatility. Compare the average of the volatilities versus the volatility of an equally weighted portfolio. Calculate the risk-reward ratio. So 12 stocks in a portfolio. How do you do it? You calculate the risk-reward ratios for all stocks, the portfolio in the market. The return formula is the new price over the old price, which will give you a percentage, but then you have to subtract 1, and that gives you a return. Then you determine the monthly average returns by using the average function, and then you determine the monthly standard deviations by using the standard deviation.s function. Compare the average of volatilities of the individual stocks versus the volatility of the equally weighted portfolio using the var.s function and the S&P 500 as the market benchmark. To annualize, simply multiply the average by 12. To annualize the standard deviation, multiply the monthly standard deviations by 12. You'll see that the vol of the portfolio is lower. So what we're saying is, once we put stocks together, we can lower our risk or our standard deviation through diversification. So when the vol of the portfolio is lower than that of individual stocks, this is a result of the term of diversification. So you find your monthly average returns, you determine the monthly standard deviations using the standard deviation formula, and then you compare the average of the vols of the individual stock versus the volatility of the equally weighted portfolio by using the var.s function, and the S&P 500 is the market benchmark. To annualize the mean, you multiply the mean by 12, and then find the square root to annualize the standard deviation. Okay, so now I want to show you something else. Advanced portfolio topics. In a 2-asset portfolio, it's just a portfolio with 2 assets. We have a spreadsheet. I'm going to go over with you. So the investor has put 60% of his investment in Cisco and the remaining in 40% in Apple. The expected return on Cisco is 9%. The expected return on Apple is 12%. So what you're doing is you put the 2 weights and the expected return, and that's going to give you your expected portfolio return. Just multiply, they have to equal 1, multiply the weights by the expected return, and then just sum the product. Okay. And to find the risk of the 2 assets, you have to do this big variance formula, right? Which is a lot of work. It's really what this does is it gives us the covariance of the standard deviations. And remember, standard deviation is not additive. So if I have 50% of my stock in a stock that has 20% standard deviation and 50% in some that has 30%, then you don't do it by saying 50% of 20 is 10 and 50% of 30 is 15, and my overall standard deviation should be 25. No, you have to compare it this way, because it'll be generally lower because it moves in different directions. Now, again, if you go to my video page, I've done a whole thing on the example of portfolio standard deviation. That's the wrong one. That's one we'll be doing later. It's this one. All right, so I'm going to share this with you, and this will absolutely help you do the work. All I did was just do the same thing you're going to be doing. I just blew it up for you for a minute. I'm going to put that back in a minute. And then when you do this work, you're going to get the risk of a 2-asset portfolio. So notice the portfolio standard deviation is going to be lower than the blend of both. If you did not 60% or 25%, 40%, 30%, you're going to get a number that's going to be higher than 24.92%, right? Because 25% times 0.6 is 15%. I'm going to store that. And 30%, 0.3 times 0.4, I'm going to store that. Recall 1 plus recall 2. That would give you an overall standard deviation of 27%. But notice it only equaled 24.9% because of diversification. Okay. Right. And then we could just keep varying our portfolio rates of return to get different standard deviations and different portfolio expected returns. And right here, where it's tangent to the line, if you did the calculus, we notice that this is your highest rate of return with your lowest risk. The minimum, by using the Excel solver function, you get the minimum variance portfolio. And they show you how to do this, and I ask you to go through it and do it, and that's the minimum variance portfolio because you ran it through the solver function. Those numbers, 78.9% of Cisco and 21% of Apple, will yield the highest return for the lowest risk by using the solver function. That'll be right there, 24.58%. And you notice that that should be your lowest rate of return. And that creates the efficient frontier, which is all the returns that these two possible stocks can make. And you can put any number of stocks. It gets really heavy math. But this is all the potential rates of return. And anything above the minimum is positive, but you have to take on more risk. And notice you don't get as much return for all the risk you take. So the marginal return based on the marginal risk is much less. And that's why there's a point here that most investors take, and they don't want to go too far because they know to get that extra return, they're going to take on more and more risk. Now, practically speaking, what does it really mean? Everybody's looking for better returns. Retirees, pension funds, everyone's looking for more return. So they're going to exist around here. To get more, you have to take on more and more risk. So that's what you really learn from this from a practical standpoint. Okay, that's what you learned from this from a practical standpoint. That to get more return, and you got to follow these steps to see how to do the solver function. But to get more return, you've got to take on more and more risk, right? And if you go back to the beginning, you'll see that I gotta go back. Right around 24.92% is the blended rate of return, blended standard deviation. That's the minimum variance portfolio. It's really neat stuff and not easy, but clearly one of the more interesting things you're going to do. Okay, well, we talked about that. That's what that light bulb tells you, what I just told you. So I'm going to go back here again, and I'm going to add that link. So you have a lot of videos here that could help you. Again, visible. Again, link. Again, there's the answer. Okay. And you got a lot of videos here. Please make use of them. Please make use of them. All right, so I'm going to go back, and I got one last thing, and then I'm going to give you some help. Oh, we did that. All right, now you know the knowledge check. So, where's the help? Well, here's what we're asking you to do, is to download this and work these numbers out. And I gave you an example of a completed one. Now, that doesn't mean just copy and paste. That does not mean just copy and paste. What it means is to use my example to assist you in completing it. There's your formulas. Excellent. Excellent video, an excellent way to see it. And here is your here's your assets. Here's your weights. Gives you expected rate of return. Here's your variance. And variance is computed by doing that same covariance. That's the covariance formula. And that gives you your overall, the square root gives you the overall, the month, the annualized standard deviation. That's per month, because those are per monthly returns. That gives you the overall standard deviation. And those are the weights. H58. And here's the capital asset pricing line. And we see that that gives you the best rate of return. Okay. And there are all the different rates. Okay. Okay. There's your minimum variance right there. And there's your return with the 2 weights. Okay. So there you go. So I gave you an example, not to be used to mimic, but to be used to guide. Okay, not to be used to mimic, but to be used to guide, as a guide. Okay. And you'll find, and there's your efficient market. Okay. So that about wraps it up for today. Let me know that you see this, please. All right. Let me know that you see it. Irrelevant what I'm saying. Okay. Well, hopefully you'll get this. Bye.